the hottest question of the year. Just exit small and mid caps. It's just the Armageddon coming for this particular category.
Nifty will probably linger around 12-14%. Okay. Whereas the mid-small micro segment, the earnings projection over the next 3 years is beyond 20%. That we've not seen such deleveraged balance sheet in the mid and small cap segment over the last 20-25 years.
How can mid cap and small cap investing help you achieve generational wealth?
Since 2007, we've got returns up to 2025.
Right.
Which is a good 18 years seen through cycles of almost three or four cycles between this period. The alpha generation through these cycles of 18 years, the small and micro cap segment have created the biggest alpha.
Hi guys, welcome to Aspro's podcast once again. And like I always promise that we'll keep bringing new topics that you are interested in, right? So this one particular episode is today going to focus on the present and the future situation of small and mid cap investing in stocks. And we have a veteran with us today, Mr. Anirudh Naha. He is Chief Investment Officer at PGIM India. You might have heard of PGIM India Group. It's a very popular group and has been known for delivering a lot of quality wealth management services across the board. And he personally has over 2 decades of experience in this particular sector, which is small and mid caps investing. And this is what he does day and night, evaluating this space, this category, and manages a large set of AUM for clients at PGIM. So, hi Anirudh, welcome to the podcast.
Thank you, Vishwas, for having me here.
Yeah. So Anirudh, I'll straight away jump into the hottest question of the year, which is like we are slowly moving into 2026. And what we saw post-COVID was that small and mid caps definitely delivered stellar returns, which has been really powerful for many investors. But as they say, that this particular category is associated with heightened risk as well, right?
Sure.
And last 12 to 18 months have not been that good, particularly if you talk about 2025, the returns have been negative largely. Right. So how do you currently make of this space? Because a lot of people and a lot of fear is also being sold right now in the market that just exit small and mid caps. It's just the Armageddon coming for this particular category.
Sure. Again, thanks for having me here. So there are quite a few questions in this. Yeah. So let's take it up slowly. I think over the last couple of decades, how the industry or the segment has evolved in the mid and small cap is amazing. And I've been lucky to be a part of this journey.
Right.
There was a time where the market cap for a mid cap company at the higher end probably would be 5,000 odd crores. Okay.
Right.
Today, we've moved far beyond that, almost at a 10x of where it used to be. Okay. That has been the journey. Today, a small cap in India starts at about $1.5 billion. Okay, so it's no more a small cap in that sense. Okay.
Yeah.
So that's the evolution that has happened in India. I think what has happened after COVID was earnings bounced back, and post that the earnings strength in small and mid caps actually played out far stronger than probably what a large cap would have played out.
Right.
Along with that, I think so generally while investing, people have been so focused on just the P&L. Because your profitability numbers or EPS numbers is what people just focus on. I think what we at PGIM have seen, we've looked at the cash flows and the balance sheets also very, very closely. Because our belief is the balance sheet is the foundation of how good a business is. We haven't seen corporate India being so clean on their balance sheets with regards to debt or so deleveraged. Where corporate India, I think so post the COVID issue, were scared whether they would survive or not. So whatever profitability or cash flow came through, they went ahead and repaid debt. Okay. So today when I talk of corporate India, especially in the mid and small cap segment, what gives me confidence about the sustainability of this segment and this segment growing up over a period of time is the fact that we've not seen such deleveraged balance sheet in the mid and small cap segment over the last 20-25 years.
God.
And that is what gives me confidence. Now, that is the the cash flow and the balance sheet part of it. Coming to P&L, let me give you a sense of how, let's say, over the last 12 months or 18 months, these segments have performed. Nifty has gone ahead and generated about a 11-12% kind of return in the last 1 year. and about 15 odd percent in the last 18 months, 1.5 years. Mid cap has been about 5%. The small cap segment has actually gone ahead and delivered a minus 5%.
Right.
Now, what is interesting to us, we looked at the period between 2008 and 2025. It's a good 25, 17 odd
17
years
period.
that we are looked at. Okay. There have been 3 instances where the divergence between the small cap and the large cap in a single year has, where the divergence has been more than 15%. Okay,
Right.
there have been three such instances. In the previous 3 instances, the balance sheets were leveraged, okay, for small caps. This time it's unleveraged or deleveraged to that extent. Okay, the earning strength has been more or less very similar. What is interesting is whenever this has happened, in the next 3 years, small caps come back extremely strongly, and the return outperformance is very strong.
Right.
Okay. And mid caps also play along with small caps. So if what you're saying is right, the last 12, 18 months have not been good for the markets. These kind of divergences. At the start of this calendar year, if you had asked me if this divergence could happen, I wouldn't have believed in it. Okay. Because we've seen consistency of earnings also playing out reasonably well in the small and mid cap space. In spite of that, this is the kind of performance that has happened. Okay. So our sense is it's a great time to start looking at small and mid caps because you've got sustainability of balance sheet, you've got good earnings growth coming through, you've got the spread of small and mid caps is huge today. Okay. The large caps are about 100 odd stocks. Anything from the 101st company is either a mid cap or a small cap. In India, you've got about 4,000 plus companies. So you can understand if you really want to create alpha over a period of time or create wealth, I think it's very difficult to ignore the small and mid cap segment with a 3-5 year perspective.
Got it. I would like to touch upon the point that you just raised that you haven't seen the kind of clean balance sheets that you're referring to in the recent times,
Right.
right? Why do you think that is the reason? Because I would like to draw a parallel here. Please tell me if I'm right or wrong in this one. Is that what we largely also saw in the US markets is that firstly, the first phase of the bigger phase of growth is done by large companies. Similarly, what has happened in India also. Then basically the small and niche companies basically take up the charge, and the even in the equity markets, the corporate earnings also start to differentiate in a way that it's not only that the large companies are making good profits.
Absolutely.
It's eventually the smaller and the mid cap companies which also start contributing to the economy in a very healthy way.
Absolutely.
Right? Is that the pattern we are seeing, and what is the reason for that growth here in these segments?
So see, the cleanliness of balance sheet, I think so, came from the fact that a lot of promoters in this mid-small segment were very skeptical about whether they would be able to survive the next 5 odd years. Please understand, we were going through a scenario where demand had collapsed during COVID, and they were sitting on debt. So in spite of top line not coming through, businesses not happening, sales not happening, you had to service your debt. And that was a fear. So people went ahead and used whatever resources were available and repaid debt. So it was a risk-off sense. Even today, what is a little disappointing is people are funding their internal growth requirements by diluting equity rather than taking debt. So that fear factor still lingers around, I guess so. But with interest rates coming down, with the government push towards making financing more available, affordable and available to the mid, small, micro segments, I think hopefully that leverage starts catching on. Coming to how diversified, whether it is well spread out, etc. Absolutely right. Even today, when you look at the large cap names, there are a lot of these businesses in the large cap segment today, which probably 5-10 years down were incubated as small or micro caps, or they came into the markets at that segment. And that is what excites us. If someone takes a 5-10 year view, the largest wealth creation over a period of time will happen not from large caps, okay? Because we did an analysis of the earnings, and let's say we looked at our earnings estimates vis-a-vis what is available on Bloomberg over the next 1 year, 2 year, 3 year, okay?
Right.
Nifty will probably linger around 12-14%, okay? Whereas the mid, small, micro segment, the earnings projection over the next 3 years is beyond 20%. Okay. In some cases, it's going to be 25. And if you've got a good, team managing actively, chances are earnings will look out far stronger than what probably a large cap segment will look out. And hence, you're at the bottom of a valuation curve to that extent on the mid and small cap segment, largely more on the small cap side with stronger earnings.
Right.
And hence, if you take a 3-5 year view, there are two positive things which will play out.
Right.
One is you're going to get earnings growth, which is better than the Nifty, and the chance of a PE re-rating happening.
Right.
Okay, because valuations have been subdued. So from that perspective, I think so. What you said on the US side is something which we are living through, and it will continue to play out that way.
Right. And I'll next jump to the valuations aspect of this particular small cap index is because largely what we have been taught as in retail investors or in general is that every particular index or kind of goes through their cycles and rotations, right? Based on valuations, how valuations progress, and because this particular segment has generated stellar returns in the last 4-5 years, valuation is a concern which people are not clear about. Are the valuations fair enough? Do they need some kind of corrections? So how do you look at valuations currently?
Sure. So see, I think the stellar returns which have happened over the last, since say 2020, post-COVID, they have been reasonably well supported by earnings. Okay, so we were again drawing at what kind of earnings have come through. In fact, we are 2 days away from this calendar year ending, literally, and we will probably extrapolate, or not extrapolate, but we will build in this year's earnings also into their numbers and then come to a conclusion. But it looks like this is the first year after 2021 where earnings in the small cap segment have been reasonably subdued. It has been actually negative to a certain extent. Vis-a-vis probably your Nifty and midcap giving you positive earnings. We actually dissected it because the small cap is a huge universe.
Right.
If someone went ahead and looked at just clean balance sheets, good promoters, and without even thinking of it, he would more or less end up with some companies out there or build a portfolio where earnings would be positive. It wouldn't be impacted. I think so. There are some segments which have taken the knock. Now, from an earnings perspective and valuations perspective, I think from a valuations perspective, generally India is enamored with PE. Okay, price to earnings. Okay, now price to earnings is something where we used to at one point of time focus on. We believe we've graduated to something more, a little more sophisticated, which gives a lot more visibility or accounts for earnings in that sense. What is known as PEG. Okay. Right. Now let me this thing simplify it for your audience. PEG is your PE divided by earnings growth. Now to give you an example, let's say there are two companies A and B. Okay. There is a company A which is available at 20 PE, and there is another company which is available at 40 PE. Ideally, if I was just looking at PE, I would go ahead and buy a 20 PE company because it's cheaper.
Right.
Okay. Now let me give you a context. The 20 PE company is growing at say 10%. Okay, whereas the 40 PE company is growing at 40%. So on a PEG, which is PE divided by earnings growth, the first company is at 2. While the second company is at 1. Okay. Right. What this formula of PEG does is it brings into context what is the earnings growth of this company. Right. Okay, and which is what makes it that much more, stronger in terms of sending across a message. So we graduated from PE to PEG quite some time back, and on a PEG perspective, I can tell you, even today, on a pecking order, frankly, small caps look extremely good. Today, it is reasonably comfortable to build a portfolio where in the small cap segment, where the PEG is below 1. Right. So basically, your earnings growth is faster than the PE available. And that is what we would look out for. So from a valuation perspective, I wouldn't be concerned about it.
Right. Got it. And, to make people understand the kind of growth generally these small and mid-cap companies have, can you give us certain examples in your research that you, like positive examples that you saw where how a very nascent stage company that has just got listed can grow really fast, and what are the sort of companies which are actually been able to crack that kind of growth, maybe particular industries or particular set of names that you can give us?
Sure. So I would avoid giving you specific names.
Yeah, these are not stock recommendations.
Yeah.
Yeah,
But
yeah.
what we would go ahead and say is what are the characteristics we look for in the
Right.
small cap segment.
Right.
I think across large, mid, or small, I think capital efficiency and capital allocation becomes the most important thing. See, India is a capital starved country. Okay, we still rely on a lot of imports of capital, either through FDI or FII, to support our growth. So a company is a part of that ecosystem. He is also capital starved. Okay, and even if he is capital surplus, I think the judicious way to use it is how you use capital. When I mentioned there is a disappointment in the fact that companies are actually diluting equity to grow, that's not something which very logical, frankly speaking. Other than the fact that the company is being cute because the valuations are high, is taking out some money out there. Okay, but I think capital allocation becomes very interesting. How do we project growth for companies, let's say, going ahead? And because investing into equities is investing into the future growth. If it's a manufacturing company, let's say, okay, it has a certain base, it's been growing at a certain pace. It meets all our criteria of, let's say, good promoters, good strong cash flows, clean balance sheet. Okay, now we try and project growth. Projecting of growth is a little technical. I will give you the technicality, and I'm sure a lot of your base would be able to probably appreciate it. See, how do you, in a manufacturing company, how do you go ahead and see whether growth is going to come through? Or how do you believe that when the promoter says, okay, the next 3 years or 5 years, we are going to grow 3 times or 4 times or say 2 times? It has to be backed by certain things. Okay.
Right.
The first thing that we look for is he started making investments on ground, because on a same capacity he's already at 70-80% utilization. How does he grow beyond that? Okay, he needs to set up capacity. How do we check on capacity? Of course, we do our visits, plant visits, new land being acquired, whether things are actually moving or not. But you can also look through it through numbers. Your cash flow from investing is a very early sign of whether the company is actually investing in it. So if he's buying plant and machinery, he's buying land, etc., it will start reflecting in your cash flow from investing. Even before that, probably there are some advances that he needs to make for plant and machinery. Okay, he needs to book it. So in the advances segment, one thing that we would look for is, are there advances towards plant and machinery or not? So these are early indicators. Finally, when he starts spending on his plant and machinery, it will start reflecting on the balance sheet as CWIP, what is known as capital work in progress.
Right.
Now, these are things that we keep looking out for to figure out if a company is going to grow or not. Okay, so manufacturing, these are very, very early indicators to us of what the management is saying. Is there is it synchronizing with how the balance sheet is growing and how the cash flows are going? So there are indicators. We have to look for these technical indicators. From a so the first important thing is how capital allocation goes. How is he funding this growth? And secondly, is the growth actually getting reflected in some of these names out there? Okay, we've seen across times, whether it is companies from manufacturing, from pharma. Last 3-4 years, there have been some phenomenal pharma success companies out there which have expanded, grown, and delivered. Many of them have actually graduated from being a small cap into a large cap, into a mid cap.
Right.
I think the biggest money is made when companies graduate from being a small cap into a mid cap, and over a period of time, probably a large cap at that point.
Right. Absolutely. So thank you, Nirud, for giving that perspective. How these companies, how do you predict growth for basically these companies? Another very important aspect that now comes is that what should be the asset allocation to this particular segment, right?
Sure.
Because, like you said, a 5 to 10 year horizon is needed for this kind of category. And let's suppose if somebody's investing, let's say 20% or 25% of his savings in equity. Now, within equity, there is also diversification needed. So, how do you generally keep the asset allocation mix in this particular segment?
So this is a question where I have a very different view. And I've been reasonably explicit about it. Your asset allocation depends on the investor's age, probably, his risk appetite, and his return expectations.
Right.
Now, believe me, even in a group of 5 people, you won't find that to be the same case. Everyone's varies according to the person. Okay.
Right.
So, what is his risk appetite? How much of a downside this thing can he take? Okay. What is his time frame for investing? Okay. What is his return expectation? And age is probably one thing. Again, on the age part, I'll come to it. So, there is no straight answer to this, frankly speaking. If it's a young guy earning with a view that he's ready to take volatility, but he wants to build wealth, this is the segment to be in, frankly speaking. And especially where India is over the next 5, 10, 15 years, I remain extremely positive on how things will play out at a broader level for India.
Right.
And hence, someone needs to take the view of probably if he is ready for a longer term perspective with drawdowns of 20, 25%. I think that this is a segment where he can definitely take a higher allocation. Someone who is not in that mind frame, looking for lower volatility, more steady income, I think Nifty is the place which will probably this thing. So what allocation, what time frame, it all varies from a single person to person. The other thing that what the industry does is, or what is usually communicated to the investor, is as you age, you take out money from risk off and move into a risk off. Let's spin it the other way around. Let's say there's a gentleman or a lady, and this is something which I have experienced. That's why I'm telling you.
Right.
Is at let's say 75, okay, and she is lucky enough to hit 100, so she is going to live for another 25 years. Adjusted for inflation, you know what is the money she requires. Okay, do your calculation. Put that into a savings bank account, taking care of her requirements for 25 years. The money which is left beyond that is actually not needed for her.
Right.
She can think of where she wants to put it. If it is, that is where generational wealth is created, actually. Okay. She could think, I will not give it to my children, I'll give it to my grandchildren. Okay. Suddenly, the money requirement goes from a requirement of a lady who's at 75 to probably the grandchildren who are at 15
Right.
or 10. The view completely changes.
Right.
Okay. And that is what I think so is a little bit differentiated in thought process. People generally say at an higher age, avoid equities. Okay. Bring down your risk appetite. I would think otherwise. You build your calculations of how long you are going to live. Okay. And 100 is a good enough time frame to think through that. Anything beyond, put it into the small and mid cap segment. Take that risk and create wealth, because your grandson or granddaughter probably at 5 or 10 years would require that money 15 years down the line or 20 years down the line.
Right.
So to answer your question, there's no single jacket or straight jacket answer to it.
Right. Absolutely. But very interesting one you raised, that generational wealth aspect that you touched. I would like to double down on that.
Sure.
Is there a possibility, because generally what salaried people feel is, yes, they can make enough money which can serve their retirement needs, right? They can build a corpus through equity. But can they really, like you said, I think this is not often talked about. I think you're probably the first guy
Sure.
that you're referring to that generational wealth aspect, that you can even think about your future generations, right? How can mid cap and small cap investing, help you achieve that in the long term?
So we've drawn since 2007, we've got returns up to 2025,
Right.
which is a good 18 years seen through cycles of almost three or four cycles between this period. And we have included 2008, okay, which is where small and micro caps were decimated, literally. Okay. The alpha generation through these cycles of 18 years, the small and micro cap segment have created the biggest alpha in spite of all these cycles, in spite of 2025 not being a great year, okay, for them. So if someone wants to create that generation wealth, I think few things. They have to really think 10, 15 years, 20 years. In India, unfortunately, investors, etc., they don't have a view beyond 3 years or 4 years. In fact, the last 1 year return not coming through have perturbed a lot of investors. Retail investors investing directly, or even whether it's a mutual fund, AIF, PMS investor. I think that's where how you handle yourself in the down cycle is where you'll create the wealth in the up cycle. Our belief, because I'm including 2008, one of the most terrible years to have been invested into the small and micro cap, and still you have been able to create an alpha in the small and micro cap segment, which is higher than the mid and the large cap. There's no two ways that if you really have that time frame, if you got a good team, if you can do it personally or individually, well and good. But if you don't think you can do it, figure out which is a good team to invest with, and give them money and the time frame to create that wealth for you. It is absolutely possible, and in a country like India, which is still developing,
Right.
I think the opportunities are humongous.
Got it. And the point that you raised that retail investors generally in India don't have a long-term view, or they, whenever the downside is there, they kind of redeem their investments. Why do you think that is the case? One is obviously the the psychological aspect to it. But do you think people get overexcited about equities and they end up investing more than that is needed? And eventually that money is needed, during some down the line. Should this be the case that only invest that amount in equities of your monthly income, which you won't need even then in the next 10, 15 years?
So this is something that we advocate very, very clearly. I think so. We advocate the fact that what you don't need for the next 5 years, bring it into equities. Okay, because 10 years is something which, frankly, even we don't have an idea of how things will evolve. But if at least 5 years, you know where your family is positioned, what is our requirements, where the education house, these are the big tickets that come through. If you are more or less settled out there, or if you don't need them in the next 5 years, I think there's a good time frame. From an over-investing perspective, see, India is still very under-invested in equities at a household level saving perspective. We are probably 5-7% or less than 5%, probably scratching the surface. In the Western world, many of the developed worlds, it's beyond 30-35%. Okay, on the upper side. So even if we go from a 5% to 10%, we wouldn't be anything where we would say we are over-invested. Yes, at an individual family level, some investors, etc., people who are in the markets might get over-invested at some point, etc. But those will be very one-off cases, frankly speaking.
Right.
So I don't think it's a problem of being over-invested. I think so it's a problem of how you manage volatility. The other way to look at it is when you go into a shop or go into a vegetable market, you are trying to negotiate everything at a lower price to buy into.
Right.
Equities markets are the one place where you really see panic setting in when you are actually getting it lower.
Right.
Okay. So if you think of it like just like anything, trying to acquire a part of a business or anything which is an article or a unit, mutual fund unit. Okay. If you are getting it lower with a view that you're going to stay invested for the next 3-5 years at least, I think it's a phenomenal time to go ahead and buy into them.
Right. One other, although tangent, that I would like to bring in here is that so there has been a lot of hate right now which rupee is facing. Right,
Yes.
It's been in the talks right now that in dollar terms rupees reached 1991, and there is a rupee depreciation price that we as Indians are paying because a lot of our products that we are consuming are in dollar terms. A lot of what we spend today for abroad education, for vacations, and a lot of other stuff is happening in dollar.
Right.
Right. So, because small and mid cap is a segment, like you said, is the one that grows the fastest in the long term. Are you also looking at opportunities outside of India to beat that currency risk and to hedge, to create some kind of hedge?
See, we actually don't need to look beyond India also, frankly speaking. If you look at it, just the way how rupee has depreciated against gold or
Right.
silver for that sake, okay,
Right.
precious metals, which are available as ETFs within India.
Right.
Okay, that's something which is absolutely available. Okay. Though rupee gets highlighted, I think so. It could also be a passive strategy where you let the rupee depreciate a little more than the rest of the currencies, just to try and make it more, competitive vis-a-vis other currencies in terms of exports. That helps. Having said that, I don't have a view on that, but that is what I think is probably going on. But having said that, from an investing perspective, if you look at it, even the dollar has lost almost 50% vis-a-vis gold in the last 1 year.
Right.
So you can't complain that the currency, rupee is also, vis-a-vis real assets, fiat money has lost a lot of its purchasing power. Give you a sense, the other way around, let's say an equity fund has generated a 25% return, okay, in the last 1 year, okay, which is a phenomenal given where the markets are. But if you look at it where gold has gone up 50%, your returns in gold terms are actually negative.
Right.
right? So it's all a perspective.
Right.
25% in rupee terms, you're happy, but when you suddenly look at it vis-a-vis gold, for that same money, gold would have probably given you a double of return in that
Right.
sense. Okay, so you're at half where gold. So these are all a perspective of how you look at it. But to diversify away from currency, within the country, you've got gold, you've got silver. There are a lot of fund of funds or funds which are available where investors can go ahead and absolutely. And we believe moving beyond India in terms of investment is something that one should definitely look at from a perspective, because there are regions, segments which India in the listed side, listed equity side, or even in the unlisted side,
Doesn't have
don't
access.
have, you don't have it available. I'll give you some simple examples. If you were supposed to ask me if you got $100, how do you go ahead and invest? Precious metals would definitely be something about 20-25%, maybe 30%. Okay,
Right.
even now. Okay, I think China tech is an amazing space to be in. Emerging market, but tech. So I would allocate towards China tech.
Yeah, it actually looks like the small cap of the tech industry because
Absolutely.
globally it has been ruled by the US. Now China is basically
That
that emerging.
switchover is happening.
Yeah.
And it is not just money flows, that it is actually technology coming out of there.
Right.
Okay, not just tech, biotech. China was nowhere there in biotechnology. The way they are filing today, their molecules, it's just amazing how they're evolving. Okay, and it is biotech is a part of that extension of technology. Okay, so that is one. Commodities, whether it is copper, aluminium, you name it, zinc, nickel, etc. India doesn't have too much of an access. It is the emerging market fund, emerging markets like Brazil or Indonesia which have access to it. So some part of money goes there.
Right.
I think what India gives you unique, okay, is the consumption space, because we've got a huge consumer market which is all internal. So you could actually break it up. You've got funds which give you access towards probably commodity markets, funds which give you access towards China. There are ETFs to play gold, silver. If you want to play US, there are funds which give you access to the US. And India probably is a core out there, where probably consumption is an amazing theme that will play out over the next 10, 15